Good morning and welcome to this Monday, August 24th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Oh, well, I'll tell you, the market doesn't really want to stop. We just keep powering forward. Friday was another good day. We'll go over those numbers and charts in just a moment. I do want to take you over to Earnings Beats, though. If you are new to Earnings Beats, we have a webinar coming up this afternoon. Love to have you. It's open to everyone. Tells you a little bit, I think, about what we do, some of the services we provide. But that will be coming up at 4:30 today. It's powerful scanning strategies for our strong earnings chart list. May take a look at a couple of the other chart lists, but primarily we want to feature the strong earnings chart list. We recently updated that, and currently we have 483 companies on that list. So plenty to choose from. And by far the largest number of companies we've ever had on our strong earnings chart list. And I've been doing this now for about 7 years, keeping a strong earnings chart list. So this is pretty powerful to have 483 companies. There's probably a number of reasons why. Number one, I think the economy is stronger than a lot of folks believe. Number two, I think because of the pandemic, there were a lot of companies that lowered their guidance, and the market was certainly was discounting things quite a bit. So I just think the bar was set really low. So a lot of companies beat. And then third, even during the pandemic, there were a lot of companies being accumulated. We saw the headlines and the big drops at the open, but big money doesn't get out with a market order at the open. That's usually individual selling, a lot of panic taking place. If you're going to see selling of large, portfolios or large, institutional money, if you're going to see the selling there, it's going to come in the form of big red candles during the day. You're going to see some pretty significant moves out of positions. Like I said, you don't see, Goldman Sachs putting in a 1 million share market order at the beginning of the day. It's just not the way the market works. So I think we have a lot of upside still left in this market. I'm going to go through that webinar later today. I think you'll enjoy it. Again, if you're not a member already at Earnings Beats, or you're not part of the community at getting the Earnings Beats Digest newsletter, which is our free newsletter, I'd encourage you to sign up there. Just type in your name, email address, hit the subscribe button, you're good to go. And if for some reason you can't make this event this afternoon, if you are part of the Earnings Beats Digest community, we will send a recording out to everyone. So that's a great way to at least get a good sense of what we do, even if you can't make it this afternoon. So we'd love to have you. All right, let's take a look quickly at what happened on Friday. We had the Dow Jones Industrial Average up almost 200 points. We're back up near 28,000. Today, futures are up pretty nicely. Last time I looked, it's probably been 15 minutes, but looked like all the major indices were going to be up close to 1%, maybe even more. Looked like NASDAQ was a little stronger than the other two, which is no big surprise. It's the way it's been. But I see the market continuing to go higher. The S&P 500 up near 1% today would take it up pretty close to 3430 at the open. And remember, we just eclipsed the all-time highs on both closing basis and intraday basis last week. So this is just tacking on and moving further and further into record high territory. The mid caps, small caps on a relative basis, you can see once again, you just look at the last 2 weeks. You see that both of them rolling back over again. NASDAQ moving to new highs, S&P's moving to new highs. Even the Dow, a lot of times the Dow and the mid caps and small caps have been all kind of performing together. That's not really been the case here over the past couple of weeks. The Dow near its 6-month high, and mid caps and small caps again both rolling over, trying to hang on to their 20-day moving averages. So still there's something going on with the small and mid caps, and I think the market's telling us something. We want to still continue to be careful with those two areas of the market. Technology had another big day on Friday, gaining $1.48 or about 1.25%, near 118, new high. Discretionary stocks continue to be on fire. Took a back seat to technology, but still gained another 0.5% on Friday. Industrials, this is a group that has been showing a little bit more strength of late. You can see easily clearing that June high and holding on to it. staying above that 20-day moving average. So far, so good there with the industrials. And then real estate had a little bit of a bounce, sitting in the 4th position from Friday, but still got work to do to get through the June high. And then the laggard, I sound like a broken record every time I talk about the laggard. It's almost always energy. Occasionally we'll throw utilities or real estate in, but for the most part, it's been energy. And energy is actually right now at about a 4-month, not far from 4-month low. Pretty discouraging in that group, considering what's been taking place in the overall market. But I think there's a lot of reasons for energy going down. And I don't think it's as much demand. For a while, it was demand. I think demand's picked back up again. I think bigger problem, number one, is supply. And then number two, the competition from renewable energy. Got these renewable energy companies that are absolutely exploding to the upside. So there's definitely some things going on with energy. There's reason why it's the laggard, and I would continue for the most part to avoid that group, other than perhaps a trade here or there. I'm not trading it, but I could see a trade here or there, and that would be about it. I just don't see the point. I'm not trying to unlock value. Energy's been trading lower and trending lower versus the S&P 500 for 9 years. So if you're trying to unlock value there, you've been doing it for a long time, and it's just, personally, it's not my style. I want to go with what the market tells me is in favor, and in my opinion, that's how you beat the S&P 500 consistently. All right, moving on, 10-year Treasury yield. As far as economic reports, nothing really out today of significance. Tomorrow, though, we do have a number of reports in the home building area. We got Case-Shiller house price index coming out, the FHFA house price index, new home sales, and then throw in consumer confidence. So we got quite a bit coming out tomorrow morning. But this morning, not a whole lot. You can see the 10-year Treasury yield currently 0.63. We've made it all the way back down to these moving averages again. And it just, if there's one thing that's really surprising me, it's that the overall trend in the 10-year Treasury yield continues to be down, which means money has overall been rotating into Treasuries. And I'm talking about just throughout 2020. Yeah, we've had these spikes to the upside. We just went through one earlier in August. But for the most part, the yield's going down. That tells us money is rotating into Treasuries. And yet, during this whole thing, and with a pandemic, we've got our major indices, the S&P 500, the NASDAQ, both at all-time highs. That's without the benefit of money rotating from the Treasury market. The bond market is getting its fair share of new money as well. So what happens if the economy truly is strengthening, and this money begins to rotate out of Treasuries? What do you think that's going to do to the stock market? I think we're going a lot higher. I mean, we're waking up today to just melt-ups in the morning. Apple, Tesla, I mean, these companies just continuing just to shoot higher every day. And that's why, again, I think you have to stick with leadership. If you're waiting for these companies to pull back, you've been waiting a long time. They're not pulling back. And I think, when you start talking about significant earnings growth, and you talk about historically low interest rates, and then the money, the rotation, not every company is able to knock it out of the ballpark in this environment. In fact, a lot of companies are struggling, but the ones that are really being rewarded. And those are the ones I think for now we need to be sticking with. Talking technically, let's move on a little bit. I wanted to go over and look at some of these FANG stocks, because the FANG stocks have really been doing well, some more than others, but they've all been doing pretty well. Facebook, I'm going to pull this one up first, take a look at it on a relative strength basis. You can see internet stocks have broken out. I still really like internet. Internet relative to the S&P 500 continues in an uptrend. So you've got the group overall performing well. Facebook relative to the internet's just went up and set a new high with this earnings move and the huge rise after earnings. That's what set the new 52-week relative high versus internet. So we've been pulling back, but we've been pulling back while we're consolidating. I think Facebook's going to break out and go higher. I like the way it looks. The accumulation distribution, I think, looks very strong. Not really anything here that I'd be too concerned with in terms of the short to intermediate term on Facebook. Yeah, I mean, maybe it's a little overbought, but a lot of these stocks are overbought. It hasn't stopped them. There's a lot of demand for these companies right now. Apple. Last time I looked, this was up another $16 this morning. I think I saw it 513. It has just been meteoric to the upside. And the volume speaks volumes as well. No pun intended there, but that is quite a move to the upside. We were at 380 less than a month ago. Now we're up over 500, and the volume that has poured into Apple. There's a reason why Warren Buffett and Berkshire own 40% of their investments is in Apple right now, might be over 40%. And Buffett's on record of talking about, not wanting to diversify. He's not a believer in diversification. He believes making bets in what he believes in, and he's made a big bet on Apple, and you can see why. So Apple looking pretty good. If we look at the relative strength, and I mean, this is almost picture perfect when I look at a chart. I want to see the stock going up. I want to see its industry group going up, the stock leading its industry group, crushing the S&P 500, and its industry group crushing the S&P 500. And if you get all those things, that's usually a good thing for your portfolio, and that's what we have right now with Apple. Amazon consolidating. Now here's another one, Amazon versus the broadline retailer. Some might look at this and say, well, it's not leading last 6-7 weeks. It just hasn't been, leading. It's just kind of going along for the ride. That's bad news. It really isn't bad news. When you consolidate, that's typical. When you make a big move up, and you see this move at the beginning of July, look at what Amazon was doing relative to its peers. It was moving up, setting a new high. And then it went through a period of consolidation, very similar to what we did back here in April. March and April, big move up. See all the sideways consolidation? Got the big move up relative, sideways consolidation. And sometimes you even see these lines move down more than this when a stock consolidates, because the market keeps going up and you've got a stock that's consolidating, not breaking out. It's going to downtrend versus the S&P 500 and sometimes versus its peers. So Amazon just made a breakout. I expect more upside here in Amazon. I think the stock looks great. Netflix. I would say this is probably the weakest of the five, but don't confuse that with me thinking bearishly about Netflix. I do not think anything bearish about Netflix. Relative to the internet group, it is definitely not one of the leaders right now. I think it's got some more consolidation to go, but off of this uptrend, we get a breakout above about 512 to 515, something like that. If you see that move back up, I think it's going to be the right side of a cup. So I think the consolidation will probably go on for a while, although in the short term, if we do get the right side of the cup, we might get a little leadership out of Netflix for a period of time. But after this consolidation period, I fully expect we're going to see more highs on Netflix. And then Google. Now, Google has filled out the cup. You can kind of see we had a false breakout on Friday. Maybe we get that breakout today. If we don't, then I would expect sideways consolidation, maybe a handle, let this 20-day come up from underneath. So if the market were to pull back, and I talk about this a lot, short term, it could happen at any time. Longer term, I'm very bullish the market. It's really hard to predict what the market's going to do in the next 2 days or 2 weeks. But I think there are signs that you can look for from a sustainable standpoint as far as evaluating the long-term picture. And I don't see anything at this point that concerns me about the market. I believe we're going a lot higher. I mean, yeah, the virus is out there. There's no doubt about that. Could we have a second wave? Could it really take a toll? Would we have to shut everything down again? I guess all of that's possible. I think the market is saying it's not going to happen. And you guys got to decide whether or not you're going to believe the market. I believe the market. I think the market is, it's definitely very efficient over the long term. Short term, it can be somewhat inefficient, but long term, it generally gets things right. But Alphabet, Google, big move up. There's your cup. Still in a very bullish pattern. Accumulation distribution looks strong. You go down here. Relative strength has definitely been a problem for Google for a while. Even though it's been going up, it's not going up as fast as internet stocks. So if you look down here at the internet group from the bottom, it's gone up 900 points off of 1,500. So that's what, 60%? Here, we've gone up from 10,000 to a little over 1,500. Not quite, well, it's probably up about 50% on Google, while the internet index is up 60%. So as a result, we've seen a little bit of a move lower in the relative strength. But The stock is still doing okay versus the S&P, and the group is still strong. So if we do get the breakout, watch that relative strength, because if we get the breakout on Alphabet, I believe we could see that relative strength pick up, and then Google could start to play some catch up with some of the other stocks in its area and in the S&P 500 in general. So overall, and before I wrap this up, maybe what I'll do is I'll take a look at a weekly chart on all of these stocks. I'll go back to the beginning first. Let's take a longer term view of these 5 stocks. Facebook, broken out, it's trending above its rising 20-week moving average. PPO is very strong. I have no problems here with Facebook. Apple, I mean, it's just a monster. Hardly even pulls back. I mean, when was the last time we had a really significant sell-off? It was probably back in March. We had this 1 week right here where we had a little bit of weakness back in, I guess that was the 3rd week of July. And that was right before earnings. Earnings came out and the stock has just been flying to the upside. And look at the volume. You might look at this volume and say, well, it's a little higher, but it's really not that much higher. Multiply the volume times the share price and tell me what you get in terms of dollar volume, because the dollar now is up at 500. You know, a year ago, the stock was at 175. So we're now almost 3 times higher. So if you're getting volume that's higher than it was a year ago, and the stock price is 2-3 times higher than it was, I think you can see the dollar volume is off the charts. A lot of money pouring into Apple right now. Amazon, very similar. I mean, look at the move. Look at the heavy volume as prices go up and up. Very, very strong action on Amazon. PPO is strong, trading above the 20-week EMA. You know, if the market were to get weak in the short term, it could really scare some folks if we were to go back and test rising 20-week moving average. It's always possibility. On Amazon, it'd be 500 points. Now, all it would take is a couple of fearful days, and you know how quickly the market can drop. But that's, you know, you got to at least be thinking that that's possible. Apple, going back to Apple, the 20 weeks at 371. We're going to open up 510, 515 today. It's 130, 140 points. That's a lot of downside to just get to a key support level on the long-term chart. And once again, I'm not saying we're going down there. I'm just saying things could, if we did have some short-term weakness, I could see definitely a lot of fear build in the market very quickly. But I'm not going to trade. I'm not looking at the market from a fearful perspective. I'm looking at the market very confidently about where the market's going, not where it might pause or where, you know, we might have a short-term pullback. I think that just gets you in trouble because then you never want to buy. How about Netflix on the weekly chart? See, I mean, Netflix on the daily chart doesn't look that great, but on the weekly chart, it's trending above its 20-week moving average. PPO keeps going up with each new high. I see nothing wrong with this stock at this point. I think Netflix still looks fine. And then Google, longer term, trying to make this breakout. Once again, look at this test of the rising 20-week moving average. PPO is strong. I see no real weaknesses here on the FANG stocks. Next up, take a look at some chart lists. I wanted to just talk about the strong AD and the weak AD chart list for a second. And keep in mind, these 2 chart lists were developed back in April, and they have not been updated. And they were not updated for a reason. I wanted to keep these together in terms of knowing which stocks were being favored during the pandemic. And when I talk about being favored, I'm talking about using the accumulation distribution line. So if I pull up Novavax, which is the highest rated stock on this list, well, this isn't a great example because the pullback in March was very short-lived and then we went straight up. But you can see the AD line remains very strong, continuing to push higher. I shouldn't say remain strong because that's not a criteria for staying on this list. Like I said, I haven't updated. There are some areas of the market that are not performing as well as they once were back in April when the AD lines were rising on some of these stocks. So there are some that have fallen apart, and that's one of the reasons why I wanted to keep this list together. I wanted to see how the market is viewing these different stocks and whether things are changing. And I would say at this point, there definitely have been some changes. But take a look at what's near the top here on the list. I mean, we still got some healthcare, technology. Those are probably the two key areas. Discretionary, there's one. We got another one here. But remember, discretionary back then wasn't as strong. Discretionary's gotten a lot stronger since April. And there are other areas that have weakened quite a bit since April, and we'll talk about that in just a minute. But I thought what I'd do is just pull up this strong AD chart list, best scooters first, so you can kind of get a sense for what is working, what has been working in the market. Here are the names: Novavax, Autoimmune, Wayfair, NVIDIA, Plug Power, Apple, iRhythm Technologies, AMD, Cadasys, QDEL. Zoom is on the list. Come down here to a software, Zscaler, the top-ranked software stock in the group that was on the strong AD. Keep moving down here, Peloton, DocuSign. I mean, these are ones that we talked about a while ago that were really good. Let's pull up, it's been almost 6 months now. It's getting close. Actually, it's been 6 months since the February high. But look at these percentages of the ones that are on top with the high scooter ratings. Look at the moves that these stocks have made. So if you identify these back in April like we did, these are the types of stocks that you could have been trading, or probably have been trading if you've been a member at Earnings Beats. These have been very, very strong companies. And you can go right down the list. Many of these companies up 100, 200% or much, much more. I mean, you can go down the list here. Here's Generac Holdings, that's 60%. Still got a 97 scooter. Here's 149%. LRN, I know I think the webinar I did with Grace and Rose back, this would have probably been in June, when we came up with 5 new stocks that we liked. LRN was one of my stocks that I picked. The stock's just in the last 6 months now up 149%. Still got stocks like CMG, Chipotle, a restaurant, only up 36% in the last 6 months, but not bad. Still got a 96 scooter score. CrowdStrike, 83%, Spotify. Anyhow, you can kind of get a sense. So these are the ones that are working. Now let's go to the bottom of the heap and see what has switched. Now, some of these don't have scooter scores. So it doesn't mean that they perform poorly. In fact, you can see Lavanga Health, 404%. C Limited, 184%. But what hasn't been working the last 6 months? So let's focus on this. And when I look over here, I can see a lot of the smaller healthcare companies, small and mid caps. See all the small mid caps? That's really what has struggled. So anything that was in that category, and I was pointing that out at the top of the show, small and mid caps rolling over, not really performing well. Well, when you look at the ones that fell apart, almost all of them were small and mid cap stocks, many of them in healthcare. That's where they looked good back in April and maybe were looking pretty good for a little while, but they've since reversed. And now look at their 6-month performance. Many of them down quite a bit. So it's not like everything on this list has been or has been great. We do have some horrible performers, but as we go down the list, we're going to start moving up pretty quickly. I mean, there's probably 40 stocks or so that maybe are under 40 on the scooter still. And most of them are small and mid-cap stocks. All right. Now let's go over to the weak AD and let's see what's been working and what hasn't been working. So here are the top scooters. Notice there are only 3 of them in the 90s. There are, let me see how many stocks are on this list right now. 267. 6 months ago. Now remember, the scooter score basically is based on what you've done the last 6 months. I mean, it doesn't matter beyond 6 months. There's nothing beyond 6 months that comes into play on the scooter, how the scooter is determined. So in the last 6 months, if you just looked at this list and said, okay, these are the bad, really weak AD stocks for the past, or back in April. When you look at it and we put it in scooter order, only 3 of them have actually done well. One's in trucking, one's in home construction, and this healthcare provider, and I think this is on our short squeeze chart list. It's probably been a pretty big squeeze. But for the most part, when I look at what's been working, getting back up over 80, look at the discretionary and the industrial stocks. That's probably the two key sectors that have made the biggest changes to the upside over the last 5 months. And that's reflected, by the way, in our portfolios. I mean, if you look at our portfolios, back in May, we had 7 consumer discretionary stocks in our 4 portfolios. This quarter, we have 14, doubled it. The industrials, we had 1 last quarter. This quarter, we have 4, quadrupled it. So 8 of them between consumer discretionary and industrials, we had 8 stocks out of 40 in our portfolios last quarter. This quarter, we have 18, more than double. And you can kind of see that just from this chart. You can see how many discretionary and industrial stocks have now moved up in the 80s and 90s from being way down below. They had, in order to be on this list, they had to have a scooter score at the time that the list was created. Their scooter score had to be below 20. So these stocks have made big moves. And you can see home construction, home construction, home construction, home construction, home construction. That's one of the big areas that has changed, no doubt. And then if we go to the bottom of the list, this is all right here. These are the ones that still aren't working. Look at what's not working. Energy, 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 real estate, real estate, real estate. I mean, I could go through. There's probably some utilities in here as well, though I don't see any at the bottom of the list. Then when we look at some of the discretionary, it's not retail. I mean, it's not like the broadline retailers or anything, autos, any of that. It's travel and tourism, recreational services, apparel retailers, recreational services, apparel retailers. These are the companies that got crushed during the initial stages of the pandemic. And these were signals for us to stay away from these stocks. They were being distributed back then. And look at their performance. I mean, well, let's look at the 6-month. Markets come flying back. Look at these stocks. Chesapeake Energy is down 93%. Most of the stocks over here, 50, 60, 70% over the last 6 months with the market coming back. These you want to stay away from. And again, a lot of people saying energy, that's so cheap. Well, it's been cheap and it keeps getting cheaper. I don't want any part of it. All right, let's take a look at earnings. There's only one company coming out after the bell today. Well, there's more than one, but one bigger company, and that's Palo Alto Networks. The stock's been in a nice uptrend, recently broken out, trending above its 20-day moving average. It's broken out versus the telecommunications equipment. I think the stock looks really strong. Its group is weak, but even being part of a very weak group, it has been crushing the S&P and it's crushing its peers. So I think we'll probably see a pretty good report coming out of PANW later today. All right, let's wrap this thing up with a 3 you must see. I'm going to start off with Taylor Morrison Home Corp. Just talked about home construction. Well, here you go, home construction. You can see off of that low back in March, big move here, coming up from just above $6 to now almost $26. AD line looks great. And I think if we pull up relative strength, I know it's doing well versus the S&P. And there you go, versus the S&P going up. It's been going up versus its peers, although the last 5 or 6 weeks during this consolidation period, it's pulled back. I would expect when we get that breakout, and it might, actually, I can't tell if it actually broke out on Friday. I suspect we could get a breakout today. If we do, I would look for that relative strength to start turning back up again. Home construction has been incredibly strong. And as I mentioned earlier, AD line, very strong on the stock. And this is, look at when it was going down, the AD was moving down, didn't quite move to new lows, but it definitely was falling very rapidly. But since then, we've seen that completely change, and now we're at a 52-week high. So that's kind of that transformation I was talking about. Next up, Shake Shack. Big change here over the past couple of weeks. Looked like the stock was ready to break down. Instead, we've come back pretty nicely, up more than 20% in the last 3 weeks. And the stock breaking to a new, I don't know, maybe 10-week high, something like that. It looks to me like Shake Shack's going to make a run here. Now, it's not Chipotle. It's not Wingstop. You know, not performing on a relative basis the way those have been, but it is starting to turn back up again. So with that breakout, again, I think we got a shot maybe for 63, 64. We'll see if we can get up there. Breakout there would be much more bullish. And then last one I wanted to mention is Expedia. Expedia, now look at this. On the move down, Expedia, I mean, its accumulation distribution, even while it was rising, kept going lower and lower. But notice the last 7 weeks. Look at that AD line. And now we're getting a breakout. So Expedia, it looks to me like it's been under some accumulation of late, performing very well. And relative to its travel and tourism peers, it's breaking out now to about a 5-6 month high. This is starting to look better. It's not, it's not it doesn't look like Apple's chart for sure, but it's definitely gotten a lot better. And the fact that we're breaking out and showing signs of accumulation, this is one that I'd at least have on my radar. Watch that rising 20-day moving average. I think that's the key. As long as we hold that, I think we're in an uptrend, and I think the stock goes higher. All right, we have just opened, so let's get a quick look, and then we'll wrap it up. We got the Dow up 200 points, the S&P's up 27, NASDAQ up another 134. Big move. Small caps and mid caps both actually performing a little bit better today, up closer to 1%. So pretty good action there overall. You can see Tesla. I mean, I don't have the see if it's no, it's still not giving the percentage here just yet. Let's take one last look at Apple, just see where we opened for the fun of it here. Apple opened up $17, 514, almost 515 bucks. So looks like another strong day, at least at the open. Everybody have a great day, have a great week, and I'll be back tomorrow over at Trading Places Live at Stock Charts. That show will start tomorrow morning, 9 o'clock as well. Have a great day, everybody. Happy trading.